In my previous video, I talked about the importance of having not only a vision of your future, but also how the more specific your goals are, the better. In this video, I'll be providing a practical guide that helps you understand whether you are on the right track for success. If you want to learn how to calculate your net worth and get a free Excel template that I personally use, stick around until the end of this video, and I guarantee you'll learn something new. So in order to understand what we're worth, we need to understand the assets and liabilities we have. I'm sure you've all heard of those terms, especially when reading a balance sheet of a company. But what do those words mean in terms of personal finance? There are two ways to look at assets and liabilities: the unconventional way and the conventional way. I'll be highlighting the importance of looking at things from an unconventional perspective and demonstrating how to calculate your net worth using the conventional definition. Using the unconventional concepts proposed by my spirit animal, Robert Kiyosaki, an asset is anything that puts money in my pocket, and a liability is anything that takes money out of my pocket. So depending on whether it puts or takes money from you, the same item can be classified differently. Take the example of a house. You could choose to live in the house or rent it out to someone else. If you choose to live in it, that means you'll have to fill the house up with expensive furniture, pay for electricity and water bills, as well as taxes and maintenance. But if you choose to rent it out or lease it to someone else, not only will that person pay you to live in the house, but you also won't have to pay for the bills and costs involved in living in that house. In other words, if you use the house for your own, it becomes a liability. If you rent it out, it becomes an asset. Take the example of a car. Despite common belief and what we instinctively think of when we see exotic luxury cars, they're mostly depreciating goods that classify as liabilities. First of all, in most cases, cars depreciate in value over time. They become used and get old. Not all cars, but that's just a rule of thumb. Owning a car also has a lot of costs. You pay taxes to legally own a car. You also need to pay insurance, pay for gas. You need to pay to maintain the car in decent condition. Especially when owning a decently good car, there are hidden costs that you never imagined of when you first bought the car. Imagine that you bought the new 3 Series. It's better looking than the older one, so people admire it. Despite it being very costly to maintain, you like the feeling that it gives you. It makes you feel better about yourself, and it makes you feel like you're one step closer to your goal. What happens is, an item like that triggers your willingness to want to appear rich. You start thinking, hey, I drive a 3 Series. I shouldn't be going to a McDonald's drive-thru alone. I'm going to pick up my girlfriend in this car, and I'm going to take her to a wine and dine place. There are subtle, hidden costs involved in driving a car, especially a luxurious one. Most people don't think about this until they realize that their spending habits have significantly changed for some reason. Take the example of another case where a car can be an asset, specifically a Tesla Model 3. With Tesla's autonomous driving capabilities, it's very likely that we'll see these cars drive themselves and essentially function as autonomous taxis. Assume you're in 2025, you own a Model 3 that drives on its own. You own it, but you don't drive it yourself for your personal use. You use it to let it drive itself as an autonomous taxi, and it helps you earn side income. It's just a car, just like the BMW 3 Series mentioned in the previous example, but it's considered an asset because it puts money in your pocket as opposed to taking money out of your pocket. It doesn't require gas money nor taxes since it's an electric vehicle, and you could be taking a nap while your Model 3 is out there driving on its own and doing its job. Robert Kiyosaki suggested a definition of clarifying these two concepts in his own way, but in reality, there are some exceptions to this rule. For instance, depending on what type of car you buy, you can still use it for yourself and consider it an asset. Take the example of high-end luxury sports utility vehicles such as the Mercedes G63 AMG or the Lamborghini Urus. These cars are extremely low in supply yet high in demand that people pay tens of thousands of dollars in premiums to purchase. As such, if you can manage to purchase a car that fits into the category of this supply and demand, you can temporarily use the car for yourself, and even when selling it as a used car, you can at least get the price you purchased the car for, meaning that you just pay for gas and rode around a $20,000 car for free, or depending on market situations, you could even get paid premiums to sell your secondhand car. The same applies to other luxurious goods that are high in demand, low in supply, and is a collectible. Take another example of Rolex watches. Rolex as a brand has established itself as the epitome of success. They have intentionally reduced the number of watches they sell in order to induce higher demand. People who manage to purchase certain models of these watches in Rolex retail stores can instantly profit 40 to 100% based on the premiums on resale prices. Considering that the average stock market returns are about 10% a year, an instant 40% profit for a $10,000 watch you purchase is an extremely solid investment. You can wear the watch yourself for a period of time, of course, not to the extent where it starts getting small scratches here and there, but you can still manage to sell it secondhand for a premium. Notice how I said certain models of Rolex watches. This only applies to certain steel models that they have. Gold watches or combination watches do not fall into the category of a good you can consume yet is considered an asset. Same goes for the example of luxury SUVs as well. Not all high-end vehicles have premiums. So from the unconventional perspective of what assets and liabilities are, you want to own as many assets as possible and as little liabilities as possible. Now that we've clarified the unconventional definition of assets and liabilities, I'll jump into the gist of this video where I demonstrate my own way of calculating my net worth. But before I do that, please make sure to like this video and subscribe for more content. Any type of feedback really motivates me to produce more quality content. If you hate everything I've previously said and haven't found it useful at all, comment down below. If you have any different ideas on your way of defining assets and liabilities, also comment that below as well. So back to calculating my net worth. I designed this method when I first turned 18 and have started tracking my record ever since. This method uses the conventional definition of assets and liabilities in that it defines assets as something containing economic value, and liabilities is a debt that requires one to give up on an economic benefit. The calculation's just so simple. My net worth is simply my assets plus my liabilities. We'll look at an example for a better explanation. Let's first assume that you have $50,000 in cash and that you're looking to purchase a $50,000 3 Series. For the sake of simplicity, let's say you can purchase this car in two ways, using your own cash or getting a loan. If you purchase the car using all the cash you have, your net worth still remains at $50,000, but in the form of a car, which in this case is a depreciating asset because the value decreases as you ride it. If you were to buy a 3 Series E21, which is the same lineup but a classic car, this would be considered an appreciating asset in which the car's value increases over time due to the fact that this car continues to grow high in demand while it's limited in supply. On the other hand, if you purchase the car by getting a loan, you'll have $50,000 in cash and a $50,000 car, but you'll also have a $50,000 debt that you need to pay back. So your net worth will remain at $50,000. This explains why net worth equals assets plus liabilities. Now, what's important to note here is that getting a loan itself does not count as your net worth having increased. You can get a $50,000 loan and spend it all on luxuriously traveling, eating at high-end restaurants, and driving Lambo rentals. In that case, because the loan was not converted to something of value, whether it depreciates or appreciates over time, but was spent on the consumption of goods and services, your net worth decreases. Your net worth depends on how you choose to spend, invest, and categorize your assets and liabilities. Here's a screenshot of the actual spreadsheet I used. I've covered some of my personal information, but bear with me. For the columns, I have my assets and liabilities written down and the increase or decrease in percentage change I see in each of them every month. For the rows, I have the date written down and I track my net worth on a monthly basis. So I'll start with the easier concepts. Cash, stocks, cryptocurrencies, and my savings all fall under the asset category for obvious reasons. On the first of every month, I update the numbers and see the change in percentage and track my progress. Cash is simply all the money I have in my deposit accounts. Stocks refers to the dollar amount that I would have if I were to sell all my stocks straight away. The same applies for cryptocurrencies. Savings refer to the money I have in my savings account. Real estate refers to the value of my property, loan included. Expensive goods refer to all the valuable goods I own, such as my car, my watch collection, and expensive jewelry and some precious metals. Lastly, I have my liabilities organized in a single column because I know what I spend my money on. I spend money on basic living costs such as food and gas. My card bills are pretty consistent and I have a frugal and fixed spending habit. Liabilities also include the loans and interests I have to pay back. Interests are essentially the cost of borrowing money from the bank, so it should fall under the liability column. So my net worth ultimately is the addition of cash, stocks, cryptocurrencies, savings, real estate, expensive goods, and liabilities. Using this formula, you can calculate your current net worth as well. With my Excel spreadsheet, all you have to do is fill in your numbers for each of the categories and your net worth will be automatically calculated. Now, moving on to the weakness of this calculation. While it's a simple yet effective method of tracking one's net worth, it doesn't take into account the qualitative aspect of your net worth, such as the monetary value of your college degree or your human resource network. Suppose that you personally know Jeff Bezos, Elon Musk, and Mark Zuckerberg. There are probably several billion-dollar opportunities that you can leverage with these connections, but this spreadsheet does not take that into account when calculating your net worth. Regardless of the imperfections, this Excel sheet is a great tool for you to keep track of your financial status and a quantitative measure to find out where your strengths and weaknesses lie. So to summarize, here are the 4 main points you need to take away from this video. In the unconventional sense, an asset is anything that puts money in your pocket, and a liability is anything that takes money out of your pocket. You need to learn how to identify assets and liabilities and gather as many assets as possible and as little liabilities as possible. In the conventional sense, an asset is anything containing economic value, and a liability is any debt that requires you to give up on an economic benefit. And lastly, your net worth equals assets plus liabilities. If you enjoyed this video, please make sure to like it, also share it with your friends, and make sure to subscribe for more quality content. In the comment section, I'll have a link to my website where you can download my spreadsheet and easily calculate your own net worth, and I'll see you guys in the next video.